So here we are in May. We've just received Chris's update from London, and it is filled with all sorts of interesting information, particularly surrounding what's happening in the US and the US dollar relative to the Aussie dollar. Now you'll see from the chart that tracks the Aussie dollar over the last, say, 5 years or so and how it's gone. And we have predicted for quite a while that we expect the Australian dollar to come off, get to more around the 60-cent US mark, and it's been taking a while, but we're very, very confident with what's happened in the US that it's going to get to that mark now. What that means to our investors is that with your asset allocation predominantly being overseas, a reduction or a drop in the Aussie dollar is going to have an immediate effect on your investment returns. So that's one good thing to take out of what's happened in the last month. The next is obviously the continuing strength of the US market relative to all other markets. And there's another chart that I've just put in that I'd like you to have a look at, and that is our relative stock market performance compared to the Nasdaq and the S&P 500. So it clearly illustrates that the Australian marketplace has really been struggling for the last 5 years, and the place to be is really in the US, Japan, and also technology stocks. The Nasdaq is absolutely flying at the moment. So they're really the key takeouts from Chris's presentation this month. And without any further delay, let's hand it over to Chris. Thanks, Chris.
It's good to be speaking to you again from London to Financial Choices clients. Here we are mid-May, and an awful lot's going on since we last updated you in mid-April. In fact, since that time, we've seen a breakout in the dollar, which I think is a very dramatic change in markets. You'll remember, if you look at a sort of futures index of the dollar, a broad dollar index, if you like, that it's been pretty range bound from the start of this year, early January, all the way through to mid-April when we last spoke to you. Since that time, the dollar on a futures index is up about 4.5%, a very dramatic move for 1 month. And of course, that's playing out against a whole host of currencies, not least the Australian dollar that you'll be aware of, that was up at 80 at the start of this year, is now sub 75, but the GB pound, where we're based in London, has fallen very sharply over the last month, as has the euro, the Japanese yen, the New Zealand dollar, and so on and so forth. A whole host of Western currencies have moved sharply down and sharply lower against the US dollar. And indeed, it's not just Western, it's of course more dramatically emerging market currencies. We've seen very significant moves across a whole host of emerging market countries and currencies, including the likes of the Argentinian peso, where we supposedly have a more markets-friendly government in place with Macri over the last few years, as well as that the Brazilian real, the Mexican peso, a number of other currencies across the globe, including the Turkish lira, where we see Erdogan again railing against monetary policy and looking to take over monetary policy from the central bank. So what's interesting is the dollar moving against a range of currencies, Western and emerging markets, and this of course is making us very nervous. Emerging market assets in our recommended asset allocation, we're underweight emerging market assets, have been for a while, and I think typically what you see when you see a stronger US dollar, you see emerging market equities and emerging market bonds and currencies indeed, of course, underperforming relative to developed markets, and in fact even going down in an absolute standalone sense. So I'd be cautious there, I'd be wary there. It's interesting as well that this dollar move is having other implications and impacts in other asset classes as well, not just emerging market equities and currencies and developed market currencies, but also in commodities. We've seen some big moves in commodities. We've seen gold in particular breaking below its $1,300 level and now trading around the sort of low 1290s, meaningfully breaking that range that it's been in for a number of months, breaking that over the last couple of weeks. And of course that's indicative of a stronger dollar. Gold tends to move the opposite way, and of course it moves the opposite way of US bond yields as well. So a weaker dollar is one of the commodities that's breaking down, and what we're seeing in the base metals, which of course are very pertinent to Australia, iron ore and copper, is a range-bound movement over the last several months. Now I think the risk is they break down from that range-bound level, they break below the key support, and start moving lower as the dollar continues to strengthen. That of course feeds into the currency and economic situation in Australia as well. and feeds into general nervousness about emerging markets, particularly those tied into key commodity prices. So we're nervous about that. We're watching that closely. I think that's key. Copper's key at around this level. And I think also elsewhere we're watching a couple of other developments. The development in the US 10-year bond yield, which is breaking above 3%. I have to say I feel instinctively it's oversold here. It needs to pause, but it's moving. It's been moving quite sharply in the last few weeks, and is a sign of things shifting underlying in global financial markets. And part of our theme that we articulated last month, the shift of global growth leadership back to the US and away from China and Europe, as it has been for the past 2 years. So that's consistent with that theme, that US driving global growth, and that is consistent with that higher bond yield. Over and above that, though, the other thing we're watching is Italian politics. This situation is changing and changing fast. Back in early March, you'll remember the Italians had an election. It was inconclusive. No one won enough seats, enough votes to form their own government. There's been a lot of discussions about coalitions, and up until this past week, none of that has made any progress. As of the past weekend, we've found the populist left, the Five Star Party, and the populist right, La Liga, Northern League in English, come together and start to discuss a coalition agreement. Now, a number of the snippets that come out that have been leaked are pretty troubling. Talking about cancelling Italian government debt that's owned by the ECB, some of it, about 10% of the total. Talking about reneging and going back to pre-Maastricht Treaty Euro rules, i.e. getting rid of the budget discipline that the Maastricht rules impose upon a country, the 3% fiscal deficit and the limit on indebtedness. Not that they've been abided by, but the coalition that's been putting together ideas and talking about getting rid of those. And of course, we're seeing an initial reaction in markets. Italian two-year bond spreads over German have been widening. The Italian 2 years have picked up from negative 10 or so basis points. They're now positive 3 or 4, which sounds very low, but it's a widening relative to German, which are significantly more negative than that. And we've seen Italian 10-year bond yields as well pick up quite meaningfully from sub 2 to over 2% yield now. They're yielding about 2.10. So the markets are starting and trying to price in the risk of this new Italian coalition. It's not clear exactly what their agenda will be, but certainly the work we've done over the course of the 6 months suggests it's not a markets-friendly agenda. It's a troubling agenda. It's an agenda with exploding budget deficits. It's an agenda where they roll back pension reforms and worsen the Italian pension situation. So it's a situation that needs to be watched closely. And it's another reason why we'd be more positive on US than European equities. But having said that, we're watching all these factors. We're underweight emerging markets, we're underweight Europe versus the US, we're overweight developed market equities, and we're overweight global equities in total. We think the bull market's alive and well, but the shift back towards the US continues to play out, and that's the key theme to keep an eye on. So thank you for listening. We look forward to catching up next month and wish you a happy investing month. Thank you.